Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Liberty. Is it worth a look at these levels or an avoid? So let's get started. First of all, a disclaimer that this is not a stock recommendation and people taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Liberty, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up from time to time. And if you pay for 10 months, that's $100 straight away, then you get 1 year access, so that's 20% extra. For detailed market or company talk, or you have a number of stocks with you, you can directly email me and we can work things out with a fee. Now about the company. Established in 1954, Liberty is one of the biggest retail brand in top quality footwear, and major brands are Heelers, Gliders, Force 10, etc., and has export operations in multiple locations. If you look at the financials now, this is where the problem lies. So sales had dropped by around 2%, and this is December numbers. Although profit went up by around 400%, yet it is believed that the numbers are primarily because of the higher operational efficiency that has taken place, and the fact that lower cost has also helped the numbers. But since the sales have not picked up compared to say 1 year, 2 years down the line, so things are not looking that great. Return on equity, so you look at the return ratios which is in single digit, which are in single digits, and that is why this stock lags behind something like a Bata or a Relaxo. If you look at the stock performance, has been an underperformer for years. So since the last 5 6 years, the stock has not done exceedingly well. Whereas you have seen all the markets, whether it's mid cap, small cap, or large cap companies, have been doing exceedingly well. At 6 year lows currently around 130, 140, 135, and the market cap of the company is around 200, 300 crores, something like that. So it hasn't been quite the way it should have been. Average return ratios has also not helped and will suffer in current business scenario. It will continue to suffer with the kind of, you can say, shutdowns, etc. we are facing across the states. So we are having state-wise lockdowns, and that is not going to help matters either. Probably what could help is a complete opened up economy, and then the sales pick up. So it do not seem like recovering at the moment or in the next 6 months to a year. So why I believe it should be an avoid. First of all, it is not a leader in its space. So we have Bata, and then we have you can say Relaxo, and we all know about it, and there have been a lot of, you can say, discussion whether to get into a Relaxo would give better returns compared to Bata, etc. I've always liked the best in the business, to buy the best in the business and to stick with them. Here this is probably third or fourth rank company. Even something like Mirza International has produced better ratios, return ratios, margins, etc., compared to something like Liberty. So that's where the problem lies here, and difficult times are ahead. So when the competition is going to, when there is competition in an industry, then it's going to get even more difficult. When you have scarce demand, when demand is less, then I think businesses suffer, and those businesses suffer who are third, fourth, fifth in the list. The first two probably get away with it and somehow manage to just scrape away with some little you can say marks here and there or blemishes. So eventually those businesses will come out trumps, whereas other businesses will fall on the wayside. And unfortunately, Liberty has been looking in the same direction. We have to see how the numbers perform going forward and then take a decision. But at this point of time, because of the return ratios and because of losing, you can say, it looks like it is losing market share, although I don't have the data to back it. But it seems like that Liberty is struggling with gaining more market share, and that is where the problem lies going forward. If somebody wants to invest the hard-earned money for a period of 3 4 years, it would be very difficult into a company that is losing market share. So Financial performance has been nothing special except for the last quarter. On the bottom line, the return ratios, etc., and sales numbers doesn't give a lot of confidence, and is another deterrent, and currently we are facing the second wave, and things are looking very difficult. Remember that major players, something like a Bata, is already down, and if you look at its all-time high, it's around 1800, 2000, and all that. It has fallen from there 20-25% lower from all those levels. Then we have Relaxo also consolidating, and so on and so forth. So people will not look at other companies, or large investors will not look at other companies in the same sector in that vigor. So major players are coming at a discount. Better to be with leaders, and that is always my opinion. And there is high debt with the company, and with the kind of scenario we are in, if the business doesn't pick up, I don't see the debt reducing as well. If you look at the stock technical, it has broken all supports, and it is currently just above the 6-year lows. So it has just moved up a little bit in the last couple of months. Otherwise, it was at abysmal levels. Need to get past 180 for any sustained up move, and you need to understand 180 has been the 52-week high. But if you look at a longer term chart of 5, 6, 7 years, around 130, 140 it is. Until the 160 levels is not taken out, you cannot even think of probably having a trade in it. Although you can trade, but I would look at it only when 160, 165 is taken out, because it is in continuous downtrend over the last 6 7 years, and probably only when it takes out 160 that things would look better in the stock. So what needs to be done? In my opinion, avoid at these levels. Complete avoid. Wait for numbers to improve. Wait for margins to improve. Wait for the company to probably do much better in terms of gaining more market share, in terms of having more presence, and showing more, you can say, resilience in these times where there is heavy competition with respect to uh, which companies survive in this kind of a scenario. This is a very difficult phase for the country, and let's just be with the large caps. That's my opinion. Not the large caps, but the best in the business. They could be mid cap companies which could be leaders in their space, and that would be my suggestion. And even if you have the company and you're making losses or something, you want to hold on to it, don't expose yourself for more than 5% to the total portfolio. And there are more options available, not only in this sector, but there are other sectors that are doing well and that look like would do well over the next couple of years, rather than just staying with something that you believe that is going to do well going forward. So my suggestion is, probably if you have not got into the stock, then probably avoid it. If you have the stock, then don't over, you can say, leverage or overexpose yourself here. Have only 5 to maximum 7% of your total holding, and sell others even in losses, and just keep them, that when your price comes, then you can exit. So this was my video on Liberty. So please like and subscribe my channel, hit the bell icon so you can get my video straight away when I post it. Thanks a lot for watching.